Donald Trump's administration has imposed tariffs of over $200 billion on Chinese items, triggering a retaliation from Beijing. What would happen if the two countries fail to reach an agreement? The US and China have slapped import taxes each other in an escalating trade war. Despite a brief respite in May following a visit to Washington by Vice Premier Liu He, the top economic advisor to Communist Party General Secretary Xi Jinping, tax increases continue to be implemented. The latest of these exchanges was in September, with the US announcing a 10% tariff on $200 billion, pound 153 BN, worth of Chinese goods, which would increase to 25% by the end of 2018. The US simultaneously threatened to add tariffs to a further $267 billion if China retaliated, which it did with 10% tariffs on $60 billion, pound 46 BN, of US imports on September 18. As this back and forth between the two countries continues, what implications will this have should an agreement fail to materialize? Speaking to Express.co.uk, Tony Hughes, CEO at global skills development company, Huthwaite International, said, "The trade war between the United States and China has escalated once again, with both sides announcing their biggest waves of punitive tariffs yet. The two superpowers have imposed export rates on more than $360 billion of manufactured goods and commodities, and analysts are predicting the battle is far from over. The clash between the world's top two economies is already hurting businesses on both sides of the Pacific, and the latest US move means roughly half of the products that China sells to the US each year will be hit by American tariffs." American multinational investment bank and financial services company Morgan Stanley has said a full-blown escalation of the trade dispute could decrease global gross domestic product by 0.81 percentage points. Car manufacturers have also been affected, with Ford and General Motors lowering profit forecasts for 2018, blaming higher steel and aluminium prices imposed by the new US tariffs. Mr. Hughes said, "Global trade growth could halve by 2020 should the US and China fail to agree a deal to halt the increase in import tariffs. The US has implemented a 10% tariff on $200 billion of Chinese imports. China has retaliated with tariffs on $60 billion of goods starting later this month. US tariffs on Chinese goods could increase to 25% should the two countries fail to agree a deal before 2019. Euler Hermes predicts that global trade growth could decelerate from roughly 4% Y/Y to 2% Y/Y by 2020 in this trade feud scenario. The average US import tariff now stands at 5.2%, the highest level since the 1980s, and compares to an average of 3.5% before the latest tariffs were imposed." Tim Focus, Director of Financial Services at political think tank Parliament Street, told Express.co.uk, "Despite markets appearing stable right now, uncertainty is creeping into the global market." Mr. Focus said, "So far, markets appear to be holding up to Trump's trade tariffs on China. But this probably more down the fact that many investors would have already priced in the tariffs. No country is safe from Trump. While the president has yet to officially slap tariffs on the likes of Germany, his protectionist rhetoric alone has created uncertainty across the German economy and more broadly across European financial markets. Until counter tariffs are enforced on the US, it is too early to say who the winners and losers will be. History tells us that protectionist policies from one country has a negative effect on everyone involved.